Well, hello and welcome to this Money Control live stream. I'm Nandita Khemka and I have with me my colleague Santosh joining in, and we'll be discussing about the Fed rate hike that was announced last evening. Santo, 25 basis point rate hike as was being widely expected, even though we had Goldman Sachs coming in and saying that the Fed could actually look at a pause this time around, but that didn't happen. But given the fact that the Fed has maintained that terminal rate target at 5.25% or thereabouts, this means that we could be looking at just one more rate hike of 25 basis points this entire year, right? So many are calling this a dovish hike. But don't you think it's a risky hike given the fact that it has come right after the stunning collapse of Silicon Valley Bank and a series of bank failures, so to say?
Well, Nandita, yes, the terminal rate, which at some point, just about a few weeks back, market was expecting that it could go as high as 6.
Yeah.
Now the feeling is that probably it could be somewhere in the range of 5 to 5.25, which is a relief. But if you look at Jerome Powell's statement very carefully, he has also indicated that credit is anyway likely to get tighter because of the turmoil that you are seeing in the banking system. Indirectly, what he is saying probably is that I won't be the bad guy anymore. The turmoil in the banking system could probably add a few more points to the rate hike, which otherwise the Fed would have to do.
Yeah.
So I don't think it's a case of where you can say that the US economy is completely out of the wood. A section of the market is even talking about a possible rate cut, but that the Fed authorities have clearly ruled that out. But what Powell had been saying all this while is that rates are likely to be higher for longer, and I think that will continue. Plus the fact that credit anyway is likely to get tighter in the system, and economic growth too has been reduced a little bit from about 0.5% to 0.4%. So when you consider all these factors, clearly it does seem like there is still a long road ahead for the US to win the battle against inflation.
But given the fact that the battle against inflation, so to say, would come to an end sooner than what was being expected earlier, because earlier we were expecting 2 weeks back, like when we were talking about it yesterday, I pointed out that 2 weeks back the narrative was completely different. We were looking at a 0.5 percentage point hike and a terminal rate shooting up to 6% and stuff like that. But now, since the Fed has indicated that the next 25 basis point could be the last one, do you think that this entire crisis has come like a blessing in disguise for the US economy's fight against, or US central bank's fight against inflation?
Yes, the Fed may say that okay, there is just one more hike, but the Fed's larger goal was clearly to reduce the credit flow in the system. Now, had this banking hike not happened, the Fed may have gone in for some more hikes, because the tone of the commentary clearly was that ongoing increases. Now what the Fed is saying is that there will anyway be tightening of credit in the system, which means that
lenders will up their standards while of lending,
lending
right?
standard will anyway become tighter, so loans won't anyway be easily available. And let's also not forget the effect of the hikes that Fed has taken so far. In some ways it is now beginning to reflect in the economy. If you look at the leading technology companies, they have shared about 52,000 jobs already in 2023, and these are the headline numbers. We're not talking about possible job losses in some of the lesser known firms in the economy. So that is now beginning to have an impact, because labor so far had been the tricky part of the equation for Fed. While it was hiking the interest rate, it was still not really been able to cool down the labor market, because there's a clear shortage of workers, and companies are not firing people because they feel that it will be much difficult to hire them later on. So all these things were making the task harder for Fed. But clearly a rate pause at this rate cut, which is it still looks unlikely, for the simple reason that the moment Fed starts cutting rate, the markets go into a celebratory mode. And that is exactly what the Fed doesn't want at this point.
So the Fed chairperson also said that there is still a case for a soft landing for the US economy. But since you talk about the tech and job losses that have kind of inflicted or afflicted the tech industry back home, Indian companies will also be impacted if there is a recession in the US, right? Because the client spending will go down, and it will reflect in the future earnings trajectory for these IT companies. So in light of that, what are you picking up? Because right now markets have already factored in chances of a recession. It's about how severe that recession would be that is a big question mark. What are you picking up from experts when you speak to them about this whole recessionary angle?
If you look at where the market is right now, the Indian market, that is, the general feeling is that even if there is a recession in the US, things may not be as bad for the Indian market, because anyway, if you look in the past 3 or 4 months, Indian markets have kind of decoupled with US markets, though last 3-4 months it was in the opposite direction. US markets were rising and we were not really performing. So there is some bit of a disconnect there. But how severe will the impact be? It is still very early to say, because to some extent IT companies clearly could feel the heat. There's already concerns, and which is why you're seeing pressure on IT stocks. If IT stocks get hit, to some extent that will affect sentiment for realty stocks as well, because IT is one of the major customers for the real estate sector. And at this point already we are seeing some bit of pain in the rural segment. There are signs of slowdown visible in the economy. More people are talking about that because interest rates also are steadily inching higher, which means that it's becoming costly for companies to borrow money, which then means that it will at some point have an impact on their profit margins. It's in fact already beginning to have. Commodity prices are fairly high. They've softened somewhat from last year's levels, but they're still high. You've got interest rates going up. When there is a pressure on margin, then this means that stock market investors will be careful about how they value the companies, because growth clearly will take a hit because of these factors.
Right, let's also talk about the banking crisis per se, because it's a very rare occurrence that both Yellen and Jerome Powell speak on the same day, and that to give out mixed signals, which of course sent the US markets tumbling in trade yesterday. Because on one hand, Powell has said that depositors must be assured that all their deposits are safe, and on the contrary, Yellen said in her comments that we won't be providing a blanket insurance for all uninsured deposits. That means only banks which have a contagion risk will be, the deposits for those banks will be insured, but rest of them won't be. And there are concerns that a couple of more banks are at risk of going belly up. They could be, because as we were talking about it yesterday also, there isn't just one cockroach in the kitchen, and you may see the impact of higher interest rates and unrealized losses on government treasuries playing out for other banks as well. So what does one make of this contradictory statement, these contradictory statements coming out of two important people?
Well, I think probably the market may have misinterpreted what Janet Yellen said yesterday, because she had already made it clear that her statement, exact words were, similar action could be warranted if some of the smaller institutions face a deposit run that in turn poses the risk of a contagion. So the banks have to first face a deposit run, and then they have to be large enough that they are a threat to the rest of the system. But the market somehow interpreted that as a blanket protection for all depositors, which in the long run is not such a good thing for the banking system, because that could encourage more risk taking by the banks, and in some ways could also make the depositors complacent. So that was never really going to be a good thing. Besides, once the regulator sets a precedent by doing something, then it will have to act in a similar way every time, and the cost of that could be really high. So in a way, she's just clarifying on what she said day before yesterday. The market seems to have misinterpreted that, and it's also important for the Federal Reserve to pacify depositors, at least to ensure that there is no imbalance in the system right now. So what is happening right now is that you're seeing a lot of flight of deposits from the smaller banks to the larger banks. So it's creating problems for both, because for the smaller banks they are losing deposits. At the same time, for the larger banks, if they get a lot of money, they don't know how to put it to good use. And let's not forget, most of the problems so far has been created not because of poor investment, poor loan decision on the asset side, it's rather due to rising interest rates. So those problems are still pretty much there. So it is important that the Fed kind of assures both market participants as well as depositors that the money is safe, else that could trigger problems of a very different kind. So whether they may actually have to live up to that promise is another thing, but for now at least they need to kind of ensure that sentiment really doesn't go bad.
Probably that's why most analysts believe that the Fed should have actually waited it out this time and let the banking crisis to play out for a couple of more months to look at a rate hike.
That's hindsight. When things are unfolding in real time, you really can't sit back and say that this is something similar to what happened during the inflation also. So to be fair to the regulators, they had a very tough job. On one hand, there was a chance that probably you might have derailed the recovery. The economy was just recovering from COVID at that point in time. Many people say that maybe they should have hiked rates back then. They should have understood that inflation was not transitory. But these things we come to know later on. So it's easy to fault regulators, but they have to deal with situation as and when they emerge. So we never know what could have happened if they would not have provided the backstop in time.
Right. Let's talk about the Indian context then. Next month we have the RBI policy coming up. April 3rd to 6th is the MPC meeting. Recently RBI has released a report where it has said that Indian markets, or Indian economy rather, is not at risk of a slowdown at least this year. But it has also pointed out that inflation will remain sticky. Remember, inflation is once again back above that 6% mark, mainly because of a rise in cereal prices. So obviously, our governor had said that we will wait and see how the situation unfolds globally and domestically before taking a call on the next rate hike. He had not indicated that last one would be the last one. And this time, since our Fed has once again gone ahead and hiked rates despite the turmoil, do you think RBI will follow the same template? And obviously, since inflation is still sticky above 6% mark, core inflation also above 6% mark, 25 basis points given in the coming month?
Hard to say at this point, but one thing is for sure, inflation in India is not as bad as what we are seeing in the US right now. That's one part of it. So probably the RBI does not need to go in for aggressive rate hikes. It has some leeway out there. That said, if US keeps hiking its interest rates, then our currency too will feel the impact in some way, because US hiking rates automatically means that their currency becomes stronger. When their currency becomes stronger, by definition, by extension, it means that our currency will get weak, and that's not the case of just the Indian currency, but this applies for all the emerging market currencies as well. So there is some bit of weakness that is inevitable if the dollar were to strengthen. Now when that happens, you could see some kind of inflation again feeding in because of a weaker rupee, and then the RBI will have to take some step. It need not always be in the form of a interest rate hike, but they will have to intervene in some way or the other. So if rates keep going up, of course, whether or not the RBI hikes rate is largely a function of inflation, but there will be other factors as well, which is we may have to react to what is happening in the US. It is unavoidable in some form or the other.
So I think I'll just come to my last question now. Equities have been on a roller coaster ride. It's been a volatile ride for equities. We are reacting to global markets sometimes. At least recently we have been given the kind of financial turmoil that we've seen in the US. We have, at a time when interest rates are going up, we have the FD rates hovering around that 7 to 8% mark, which I don't think when we saw such rates for fixed deposits last. So in that sense, banks are almost at a war to woo depositors. Do you think this is the time to actually steer clear of equities and look at fixed income right now, given the rate, deposit rates, and the stability that a fixed income product gives to your investment portfolio?
So two things here. So one is clearly on paper, it does make sense to shift some money from equities to debt. That's because equity returns have been pretty much flat for almost 18 months now. They've not been meaningful. Again, if you're directly invested in stocks, depends on which stocks you've been invested in and whether they have performed well. But on the whole, if you are a mutual fund investor, chances are that you are staring at either flat or even negative returns in some cases. So that being the case, there is a justification in moving some part of money to fixed income. But let's not forget, the general perception about fixed income is that they are risk free, which is not necessarily the case. Depends on which fixed income. As events in the US have shown, right? It doesn't mean that if you're putting money in a bank, the money is 100% safe. And we had seen something like that in 2008 as well, where many of the fixed maturity plans of mutual funds, they had fallen below the par value. Investors who had put money in FMP had actually lost. That's because mutual funds had invested in securities which suddenly turned illiquid at that point in time because of the crisis in money markets. So when you're putting money in fixed income, you need to keep in mind that they're not 100% safe, risk-free. I mean, of course, they are far less risky compared to equities, but they're not exactly risk-free in that sense. So when you're shifting money, you just need to keep in mind the fact that these are very unusual market situations. We had seen something similar in 2008 also. And there's also an interesting article which one of our colleagues had written on Money Control yesterday, and Warren Buffett's approach to investing, in terms of high interest rates. So he says that typically the time to be investing in equities is when interest rates are at their peak or near the peak. That's because from then on interest rates can only go lower, and the slight change reduction makes a huge difference to the company's earnings. So that is another way of looking at it. Is this the time you should actually be moving out of equities into fixed income? Although equities have been underperforming for some time now, and they've almost been giving negative returns. So if you can make 7%, 8% without losing sleep, that's not a bad thing.
That's not a bad thing. Well, I think you had a great chat, and do check out that article that Santosh was alluding to. That will help you in your investment. That will help you decide on what investment avenues you need to tap right now. But I think with that, we've come to the end of this Money Control live stream. But for more news and updates, stay tuned to Money Control, and don't forget to tune in at 12:30 p.m. when we talk about the midday market mood setup.